Hi, it's Nash from Alpha Phi. Please smash that like button, hit the subscribe so you don't miss out on anything. Today we're going to talk about a nuanced topic relating to whole life insurance, which is direct and non-direct recognition treatment of dividend payments paid by whole life insurance companies. So this can be a complicated topic to wrap your heads around, but you generally hear about high cash value whole life having a lot of cash value that you can access early, providing that liquidity so you can redeploy into assets. And when you take policy loans against that cash value to access the liquidity, even though you've taken some or all of the money through a policy loan that's in your cash value, your policy continues to grow and compound as if you hadn't touched it in the first place. So that is still true, but there are two key types of insurance companies. One is direct and the other is non-direct recognition. And so what's going on here is that if you take a policy loan, they may treat the dividends on the non-loaned funds differently compared to the loaned funds. So dividends, again, are the interest and non-guaranteed dividends, just like a stock company pays a dividend. But in whole life insurance, the dividends are normally set up to buy more PUAs or paid up additional whole life insurance, which has a very high cash value crediting rate, which credits more cash value back into your policy year over year in not only cash value but death benefit. So the dividend treatment or the dividend crediting rate can be different with direct recognition companies on loaned funds that you've taken a loan against your cash value. Non-direct recognition companies do not have or apply a different dividend crediting rate on non-loaned funds compared to loaned funds. So that is the key difference. It's not a large amount. For example, right now Guardian's dividend is 5.75%. And so that 5.75% gross dividend is paid on against non-loaned funds in your cash value. On loaned funds, it would pay a 5% dividend crediting rate. The reason it's 5% is they actually match it to the fixed policy loan interest rate. So normally companies who have direct recognition treatment are fixed policy loan interest rates. Companies that have non-direct recognition treatment are normally variable policy loan interest rates. And I'm going to show you companies and the treatments they have in just a moment on the next slide. So what's going on here, if you receive a different dividend crediting rate, your cash value growth may be impacted. It could be unfavorable or favorable depending on where dividends are and depending on where policy loan interest rates are, because normally it's adjusted to match that policy loan interest rate. For example, new Guardian products that I quoted earlier, 5.75 dividend in 2023. New Guardian products have a policy loan interest rate of 5%. So that drops the dividend down 0.75%. Old products have a policy loan interest rate with Guardian fixed at 6%, so it would actually increase. Other companies are a little different. We're going to dive into that in just a second. There is a way around it to get, if you would say, the best of both worlds, but this is essentially taking a third-party line of credit against your cash value. You can put your policy up as collateral. A bank will give you a third-party line of credit. You can either get a fixed or variable loan interest rate on that line of credit, and there's no direct recognition treatment on those as well against your policy. Okay, let's dive into different types of companies. So I've got here a lot of the major companies and then some of the minor ones. The major companies that have a proven track record of performance, very large, strong financial backing, as you can see with the rating companies and Comdex score that combines all of those, is Mass Mutual, Guardian, Northwestern Mutual, and New York Life. So let's run through both of those. Mass actually has both direct and non-direct recognition types of policies, and the key is normally whether LISR is attached to life insurance supplement rider. I normally attach LISR to all types of policies that I do with Mass. The reason is LISR provides the flexibility to bump your payments up and down from year to year. You can't pay in at leisure like Guardian, but you can bump your payments up and down with LISR, as opposed to having some minimum hurdles to hit with Mass. So normally, actually, with LISR, Mass Mutual is non-direct recognition. Guardian has both options as well, however, a little more on the direct recognition side. So Guardian starts off at a fixed policy loan interest rate of 5% or 4.76% if you pay your policy loan interest every single year with the new products post 7702. You do have the option at year 10 to switch over to a variable policy loan interest rate. That would switch your policy over to a non-direct recognition treatment as well. So essentially, Guardian starts off as direct recognition, but you do have that one-time option at year 10. Northwestern Mutual is direct recognition. New York Life is non-direct recognition. And then Penn Mutual and Lafayette Life here. Penn is direct recognition. And one thing to note with Penn is they're direct recognition and variable interest. So right now, with interest rates taking off, not only are you having your your dividend rate dropping quite a bit, but also the variable loan interest may be taking off, so you're kind of getting a double hit there. So it's good to be aware of. And then Lafayette Life, smaller company, does not do business in New York, which is key. If you know what that means, is non-direct recognition. I'm going to jump into an example now so we can see what the impact is with a given loan scenario. Okay, here I've got a 40-year-old male, preferred health rating, with a policy designed for maximum cash value, so 10% of the money or less going into base premium, 90% going to PUAs. Total out of pocket for 5 years is $100,000, so about $10,000 or so of that being base premium. Actually, with this company, you can go a little less. So $100,000 out for 5 years, $500 total out of pocket. So I'm going to hide these outlays just so we can look at all these scenarios side by side, but wanted to let you know that it's $100,000 for 5 years, $500,000 total out of pocket. So we have the gross scenario. In this instance, the policy is actually breaking even by year 4. Right, so 100,000 times 4 years is 400,000 total out of pocket. By year 4, we have 405,119 in cash value and $2 million in death benefit. The reason that is we've selected the Guardian short-term performance PUA, which gives preference to short-term cash value liquidity performance. You can see that the cash value showing up in year 1 is also very high, 88%, or 100,000 out, 88,335 in cash value you can access within 10 business days. But what we've got here in comparison is a loan taken out at year 11 and showing what the difference in cash value growth is with that direct recognition treatment. So on the growth scale, all of the money will be growing at a gross dividend rate of 5.75%. On the direct recognition side, the loan of $100,000 will be receiving a dividend of 5%. Again, this is gross numbers. That's why I always like to look at the IRRs here, seeing what's actually happening after mortality expenses and insurance expenses, that sort of thing that the company has to incur to operate and pay out death benefit claims and things. So that's the true IRR, net cash value year-over-year growth. But anyways, back to this. 5%. So what does that do? Taking a $100,000 loan for 5 years, paying it back in year 6. So $100,000 out of pocket. You'll see the cash value drop a little bit here by $100,000 plus the growth year over year. As I said earlier, it's a 5% policy loan interest rate. Well, then you know this interest due here. Why is it not $5,000? 100,000 times 5% is $5,000. Well, if you pay the policy loan interest on or before your policy anniversary date, you actually get a slight discount, and your policy loan interest would be 4.76% or 4.762%. This assumes you take a policy loan on day one of your policy year and you pay it back on on your policy anniversary date, not allowing it to compound into the next policy year on an interest basis, a loan interest basis. If you do, it would compound at 5%, add to your loan balance, and that's when it compounds against you, and you don't want to do that. You want to pay it on your policy anniversary date, keep that interest simple, and get this little discount. If you pay it early, you would actually receive a this accrues daily. So however many days you pay your loan back, you would get a discount credited back to your policy. Okay, so you can see here, this is the difference in cash value with taking that $100,000 loan. So at the end of 6 years, your cash value is actually $6,800 or so less as compared to if you hadn't taken a loan in the first place. So let's look here, $804,968 in cash value as opposed to $811,838. And you can see the death benefit is also a little bit less as well because the dividends are less. The PUAs that those dividends each year are buying, the PUAs are paid up additional whole life contracts having a death benefit amount and a cash value to them. That's why this compounds and grows. So both are actually impacted. But for a $100,000 loan, it's not that bad, but you'll see that it continues to grow here. So let's look out at age 70. With that $100,000 loan, it's $13,640 in difference there of cash value. Now, what happens on the non-direct recognition side of the fence? So here we can do essentially the same comparison, but flipping it over to the variable loan interest rate. You'll see the variable loan interest today, March. Actually, I ran this a while ago, but in 2023 is higher, right? The Fed funds rate is higher. Moody's AAA corporate bond has been drifting up, so it'd be 5.4%, so a little bit higher. But taking a loan, there's essentially no difference in cash value compared to the growth model. So when you pay it back, you have the exact same values on both sides of the equation. So I hope this was helpful to understand what would happen if I take a policy loan. In the next video, we're actually going to look at some strategies of how we can minimize the impact of direct recognition treatment on our policies and what we can do to kind of minimize the impact even though it is having that direct recognition treatment. Just a little look ahead. If you're paying kind of constantly, having cash flow cycling through the policy, it effectively lowers your loan balance and the impact of the direct recognition treatment. So a lot of us real estate investors or business owners have a lot of cash flow coming in and out. So really, it's not going to be $100,000 and then $0 being funded back into the policy for 6 years. Sometimes that is the case, but if it's not the case, we'll actually look into and explore how this would differ with cash flow cycling through the policy year over year. So tune into that one. If you have any questions, If you have any questions, please drop them in the comments and I'll get to them as soon as I can. Thank you. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.